This is the Saturday news roundup from the past week and how I'm going to be investing moving forward because of this information. Warren Buffett finally dipped into his deep pockets and actually bought into a super undervalued stock. In a recent video, I gave my thoughts on this stock and it looks like Warren Buffett and I were thinking about the same. Many have asked my thoughts on UNH. This is still a market leader with a deep moat. It's still the largest health insurer in the US and owns Optum, a powerhouse in healthcare services, pharmacy benefits, and data analytics. I think it will eventually recover, but I don't think it's going to happen till the end of 2026, probably more so in 2027. Long-term investors may make some good money on this one, but you're going to have to be patient, and there may be a good portion of time where this thing looks scary. It looks like it's never going to come back. I do think that it'll come back at some point though. Warren Buffett's Berkshire Hathaway bought more than 5 million shares in United Health last quarter for a stake worth about $1.6 billion. United Health shares jumped in after-hours trading after Buffett's latest quarterly filing was revealed. A bunch of other big names disclosed that they had bought into UNH over this last quarter as well. And I just think that we have seen the bottom for United Health. I think that it's going to gradually go up. They're going to have to pay some fines. It's maybe not the best and most ethical company in the world, but I do believe that that's going to be going up from here. As always, I'm going to be going over the most important news from this past week and give you the highlight version because I know that your time is much more valuable than just sitting and having a long drawn out YouTube video. I'm also going to give you my thoughts on where I think you should focus your investing going into the end of the year and into next year. My name's Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. So first, I'm going to make good on my promise from last week. I told you that if you comment a question down below, I'm going to pick one and I'm going to go ahead and answer it in the next video. So if you have a burning question today, ask it down below and I'll answer yours for next Saturday. Since today's the first one of doing these, I'm going to do a bonus and answer 2 questions. First, from Elvis Karaoke. Does the Professor G ever talk about swing trading ETFs? Quick answer, no. Well, kind of. I'm just going to say don't do it. That's a very risky way to speculate, and on this channel I try to teach investing, which is a long-term buy and hold strategy where you buy into solid ETFs or solid blue chip companies and hold for the long term, very much like what Warren Buffett teaches. A lot of people don't really love that because they don't want to get rich slow, and so they fall into this false attraction of get rich quick, and 99% of them lose a bunch of money, and then they actually have to go back and start worse than they were when they first started. I'd be very careful day trading or swing trading anything. Next was from April XM. My question is, do you think there's a bubble that's going to burst in the stock market? Many people have talked about how overvalued stocks are, but even after the drop when tariffs were first announced, the stock market recovered quickly. Why do people think there's going to be a correction? What are the signs? It looks like it's going to keep going up because people continue to invest, especially in retirement accounts. It's very volatile, but what would cause an actual correction or crash? Really good question and good keen observations there. We did see a dip or a crash in April when the tariffs were announced. And so in the short term, yes, we'll see little dips, we'll see crashes that feel very, very big. But in the grand scheme of things, when we really look back at the chart, that April dip doesn't look too crazy because we recovered so quickly. Now, not all dips or corrections are going to recover like that, but a lot of them have been recovering about that fast recently. Some signs though that let us know if we're overvalued, undervalued, if this is a good time to invest, how the market's actually feeling. I like to look at the fear and greed index, and especially the market momentum as far as the S&P 500 versus the 125-day moving average. It's useful to look at stock market levels compared to where they've been over the past few months. When the S&P 500 is above its moving or rolling average of the prior 125 trading days, that's a sign of positive momentum. But if the index is below this average, it shows investors are getting skittish. The fear and greed index uses slowing momentum as a signal for fear and a growing momentum for greed. Basically, between that fear or greed, if it's saying greed, it's saying that most people are just thinking, yeah, the stock market's going to be great, and so they're investing. But that's not necessarily the best time to be investing, because if everyone thinks that it's going to be good, they're not having that downside protection, And that might be a time that things are a little bit overvalued, and so you might want to wait a little bit depending on what your strategy is. All that being said, I do believe that we're in store for somewhat of a correction, especially towards the end of the year or beginning of next year. The effects of the tariffs just haven't been felt yet. We haven't even actually got the full tariffs yet. They keep getting pushed back for 90 days on certain countries. I believe by Q4 of this year or Q1 of the following year, we're going to start seeing what these tariffs are actually doing to companies' bottom line. It's going to bring the profit down, at least initially, and by doing so, it's going to have an earnings report or two that are going to come in less than what analysts had predicted, and that's going to then bring down the stock, and if overall a bunch of stocks are doing that, the overall market's going to drop a bunch. I don't know if we're going to see a crash per se, but a dip of 5 to 10% is definitely within the cards. If you're investing in something tried and true that's always come back, something like the S&P 500 or the total US stock market or even the NASDAQ 100 or Dow, those things have gone through crazy recessions and the financial crisis and COVID, and they've made it out on top eventually. So when a big dip happens, I just double down on my 3-fund portfolio, and it's served me and my clients very well. Another thing to do to get out ahead of something like that is to hedge some of your investments by making sure you have good blue chip dividend style stocks or ETFs. And I'll talk about that a little bit more near the end because I have a couple that I think would be really smart for your portfolio. Okay, on to some news for this week. Earlier this week, we had CPI data report that was actually very good and actually gives us grounds for a rate cut coming in September. But then later in the week, we had the PPI report, which kind of made things a little bit messy, and now we don't really know if we're going to have a rate cut or not. The recent July Consumer Price Index CPI report has fueled expectations of a potential Federal Reserve rate cut in September. While the overall inflation rate remains above the Fed's 2% target, the latest data, particularly the slower than expected rise in core CPI, has increased the likelihood of the Fed lowering interest rates. This is further supported by weaker than expected labor market data, which could push the Fed to prioritize employment. The July jobs report also indicated a slowdown in hiring. This could make the Fed more inclined to cut rates. The Fed's mandate is to maintain stable prices or low inflation and maximum employment. The latest data suggests a balancing act for the Fed, potentially prioritizing one over the other in the short term. But then, like I said, that PPI just came out a couple days ago, and that wasn't great. The PPI data released this week showed a much sharper increase in wholesale inflation than anticipated. The overall PPI rose 3.3% year over year, well above the forecasted 2.5%, and core PPI jumps 3.7%, marking the highest level in 3 years. This unexpected spike has shaken investor confidence in the likelihood of near-term Fed rate cuts, tempering earlier optimism. We'll see what actually happens, but right now it's kind of up in the air for what's going to happen this next month. In the actual stock market, we've seen kind of a mixed reaction for a couple of different reasons. Despite inflation worries, major indexes held firm. The S&P 500 logged another record close, while the NASDAQ and Dow showed minor fluctuations. The strength came largely from big tech names like Amazon, which climbed 2.9% thanks to expanded same-day grocery delivery offerings. However, the gains weren't broad-based. Smaller companies, especially those outside the tech sector, lagged behind. The Russell 2000 fell. For investors prioritizing stability and income, companies with proven dividend growth are compelling. In an environment of macro uncertainty and possible rate fluctuations, high-quality dividend growers offer both income and downside resilience. So in this situation that we're in, where we don't really know what's going on with the rate, but we do see a lot of fluctuation, we see a lot of volatility, and a possible crash coming, a possible big dip coming near the end of the year or beginning of next year, it's probably smart to have some of these types of companies or ETFs. I'd recommend taking a look at the dividend kings at a time like this. Some key traits of dividend kings: 50 plus years of annual dividend increases, which means they survived multiple market downturns while still rewarding shareholders. These types of companies have strong, stable business models, often have wide moats, steady demand, and dominant market positions. Definitely shareholder-friendly management, which focus on returning capital to investors over decades. And they're typically large, established companies. Many operate in consumer staples, industrials, or utilities. This list here is the example of dividend kings as of 2025. Some of my favorites are Procter & Gamble, Coca-Cola, and Johnson & Johnson. All of these have had 60 plus years of dividend increases. That's not just saying that they had a dividend each and every year for 60 years. That means they've increased their dividend every year for 60 years. Meaning that had you bought in 10 years ago, you get to buy this dividend stock at a certain price with a certain dividend. And not only is that stock probably going up, but so is the dividend percentage that you're receiving. And you only had to pay in at this certain price for that dividend. So you get growth in two different areas, which is a superpower. Investors love dividend kings because of the reliable income, even in tough markets, the inflation protection, because the growing payouts help maintain purchasing power, and the signal of financial health. Very few companies can sustain this streak. Now, I go over all of this, plus all the different metrics that you need to know if you do want to invest in certain types of dividend stocks or even ETFs, in this course that I built out with an actual dividend expert, Ryan Williams. And so both of us go in on what's the best way to invest in dividends, dividend taxes, which specific accounts to invest in, all of that kind of stuff. This type of course I've seen for thousands of dollars, but I just compiled 17 videos all in one place that you can access forever. And it's on sale right now for only $79. You can find the link down in my description, and like I said, it's on sale now, but the price is definitely going to go up at the end of this month. I've literally had thousands of people that have already bought in on this course, and I get such great reviews. So many people have started out their portfolio and have felt so much stronger, especially in that dip that happened in April. For those that had a smaller portion of their portfolio in something like those dividend style companies or ETFs, they didn't see quite the same dip as the rest of the market. I personally am investing very heavily in solid dividend ETFs like SCHD or VYM, specifically for this downside protection and what I talk about in the 3-fund portfolio. You should have at least one section of your portfolio that's there just in case of these types of dips that we're absolutely going to see in the near future. We don't know what's coming, but what I do know is that this crazy AI boom and technology boom is getting a lot of interest right now, but it's very similar to what was happening in the tech boom or the dot-com bubble of 1999, and we saw what happened there. We got really, really high, people were all hyped up, and then it kind of came back to reality. I would definitely check out that course. Link is down in my description and it's on sale now. And once you do that, go ahead and watch either of these 2 videos to keep you going strong in your investing journey. And remember to keep investing simplified.